Good morning, everyone. Welcome to this rundown for the 17th of February. It's titled the Playbook for 2019 for this week's edition. And what I want to do is to really, lay out how I see things that have really become very clear in the last 4 or 5 weeks, basically since we turned the corner at the start of this year. It's been building up for the last 6 months, but we weren't really sure where things would go. But I think it's pretty clear now the sort of environment that we've got ahead of us. And one of the reasons that I say that, the major reason that I say that, is because central banks have now basically capitulated. And I think that is one of the most significant things that's happened in the last 20 years. And I'm just amazed that commentators aren't talking more about the importance and the significance of what central banks have just done. So I think that's really made the path forward look a whole lot clearer, and I wanted to address that this week. Now, if you've been watching these videos for any length of time, you'll know that my fundamental orientation is bullish. It's not bullish with blinkers on. I play the ball as it comes down the pitch, and I call it as I see it. But if there is any doubt, if it's 50-50 between being bullish and bearish, then I will have a tendency to be bullish. And you'll see from this video that I'm, if anything, leading a bit to the bearish side. So this is quite a change in outlook for me. But nevertheless, I'm still excited by the opportunities. So let's go through it. So really, I want to examine where the fundamentals are going to drag stocks in 2019. Now, the market is a combination, or the way the market moves is a combination of short-term sentiment. And at the moment, short-term sentiment is winning and it's positive. But the other part is fundamentals. So we've got sentiment and fundamentals. Short-term sentiment is positive. Longer-term fundamentals are certainly pointing to a more negative outcome. And so for the majority of stocks, I think the outlook is not appealing. It doesn't apply to all stocks, but certainly to the majority. I'll have a look at the normal stock and commodity trend update. And Portfolio Analyst last week, we looked at a number of things. It was a pretty good session with lots of great questions. We looked at the Australian finance sector. We did a small cap review of local stocks and also the local high growth stock review, stocks like Afterpay Touch, WiseTech Global, Altium, Appen, etc. All right, so let's jump into it. So where are most stocks going in 2019 and beyond? So as I said before, stock trends are driven by sentiment and fundamentals. Short term is sentiment. It's now positive because the central banks, and particularly the Fed, has stopped tightening. And also there is some maybe apparent progress on the trade dispute between the US and China. So that's why short-term sentiment has swung positive. But longer term, the fundamentals are actually deteriorating. And the outlook, I think, from a fundamental perspective is now negative. And those fundamentals over the longer term will come into play. It's no question. Now, the bond market is critical, and I know that a certain percentage of people watching this video will be tempted to switch off because they don't understand the bond market and they really don't care. I would really implore you not to do that. This is so important to, if you don't understand it fully, at least get a little bit of an overview, but stick around for, where the impacts are going to be on stocks, because this really is absolutely critical. So going back a couple of years, it was pretty obvious that a 35-year bond bull market appeared to be over. So bonds going up meant yields were going down. And, we all experienced bonds and interest rates going down from 15% down to, 1%. So that appeared to be over in 2016. Rates started rising. The Fed started tentatively raising rates. And all that seemed very logical. Central banks had a plan. They planned to stimulate coming out of the GFC for a period of years. And then at some point, when the economies were healthy enough, then they'd back out. So that was the plan. The 10-year yield rose to 3.25 from a low of, I think it was about 1.5. So that was all logical. That was what was exactly to be expected and made sense. And once we broke out and got to 3.25, everyone thought that 4% was a no-brainer. It was absolutely going to happen and nothing would stop it. And then all of a sudden, that only lasted a couple of weeks, then all of a sudden yields stopped rising and they promptly reversed. Stocks got walloped in February of last year and again in October through to December of last year. And this is all related to the bond market. So why did that occur? It's only really just recently become apparent because of announcements and releases from the major central banks, but it wasn't really interest rates going up under normal market forces. What was happening was that the central banks of Russia, China, Brazil, and Japan in particular were forced to sell bonds because a heck of a lot of world trade is done in US dollars. And there's actually a bit of a supply crunch in US dollars, and it's been going on now for a couple of years. The major US banks who fund what's called the euro dollar, which is basically funding for trade around the world, they'd basically been pulling back from that market. And so there was actually a bit of a deficit of US dollars to fund the operation of economies. And so those major central banks were forced to sell bonds. And so bonds went down and rates went up. And it really wasn't the market forces that everybody thought it was. So the second thing that happened then, it became obvious that growth was slowing. And that's really happened in the last 6 months. And so the support for bonds came back. So bonds went up and yields fell back again. And so that's really what's occurred. And that's why the US 10-year has fallen from 3.25 back to about 2.65 at the moment. And of course, all of that has led to stocks surging back in 2019. But the question is that rally, which we'll take a look at in a minute, is that sustainable? The longer term for most stocks, and I really want you to absorb what I'm saying here, so don't just get an impression that all of a sudden I've turned completely negative on the market, because I haven't, but I've certainly become a lot more cautious. So the longer term for most stocks, I think, is now rapidly becoming unappealing. We're getting a lot of data points now. Europe industrial production is down by 4.2%. That's a heck of a lot, considering that the central bank, the ECB, has really not done any tightening at all. China industrial production is in trouble, and China's going to have to pull some levers big time in that economy. The US earnings season has come through really quite well. So that's been fine, around about 16% growth, and more than 70% of companies have beaten expectations. So the current earnings season, no problem. But the outlook is very weak, and that's a concern. The Baltic Dry Shipping Index is down by 60% since July. That is huge, and that is a real indicator. It's a leading indicator, and it's showing just how weak global trade is. Now, okay, part of that could be due to the trade dispute, but that's a heck of a big fall. So therefore, all that leads me to conclude that the playbook, the plan that central banks had, that was to stimulate for a period of years and then back out, that's now toast. It's done. 17 countries still have negative yields of varying lengths, most of them longer term, 5, 10 years and above, still have negative yields. And yet economies are now waning. This is extraordinary. So clearly the central bank plan has not worked because the stimulus has not worked. The Fed tried to tighten, and then they were forced to stop. They forced to stop well short of where they wanted to be, and where would be normal. So that means that when the next recession comes around, and it's now looking far more likely than it did, then there's not much ammunition. And the ECB has got no ammunition. They're between a rock and a hard place. They didn't even get to tighten, yet some of the economies, we've got Italy in recession, and we've got Germany and France and Spain just limping along. So their economies are in trouble, and they didn't even get to that point. So the overall reality is that central banks have lost the ability to impact economies, and that is serious. And as I said right at the start, this is not getting the attention in the media that it well and truly deserves. The risk is that unpredictable market forces just overwhelm central bank policy. We saw a glimpse of that in the late part of December, when the market basically went into freefall. Over a week, it fell 7% leading into Christmas, the worst week of December since 1929. So the risk is that sort of market action that we saw in the middle to the latter half of December keeps repeating. The end result, I believe, is that the vast majority of stocks are going to prove to be overvalued in what will be a deflationary global environment. Now, this is a very significant change in outlook for me. I've not been this definitely negative for many, many years. So, I think they've changed, but in a way they've become clearer because we now know where central banks stand. We now know that if anything, central banks are going to lower rates and increase stimulus, if anything. So expect plenty of volatility. So what will do well in this environment? So this is really the crunch of it, and then I'll get on with the rest of the normal coverage of stocks and commodities. So what will do well? I think there's three main categories that'll do well. Stocks that are relatively cheap and undervalued and can grow their earnings in this kind of environment. Now, that's not many. Percentage-wise, it's a very small number of stocks that have the ability to do that, and it's going to take a lot of shoe leather to find those sort of stocks, but they will be out there. They're always out there. I think you can divide that into two sections. Larger stocks that are undervalued because they're misunderstood. The market just doesn't get that the company is better positioned than what the predictions would indicate. And in Australia, there's a couple of stocks. I mean, I've talked about it. And these aren't recommendations, but this is just an observation of reality. I think a stock like Webjet is undervalued at this point in time. It's a large cap stock. I believe it's undervalued because it's misunderstood by the market. So there are a few of those examples. Then we've also got small stocks, small caps and micro caps that are undervalued and cheap because they're just under the radar. No one knows about them very much. They're not covered by mainstream analysts, and so they're cheap. So that's an opportunity. The second group are select stocks that appear to be expensive, but they just keep going up and they keep trading at really high multiples. And examples of that in Australia, Afterpay Touch, and Altium and WiseTech Global and those sort of stocks. In America, Amazon is a great example. And the reason that I think this occurs is that their growth is so strong because they've either got a network effect or they've got an ecosystem that insulates them from other market forces. And that encourages investors to sustain the very high multiples. And if you look at the price charts of Amazon and Afterpay Touch and the like, they're still remarkably strong. The third group, I believe, is gold stocks, which I think will do quite well in this environment because as people progressively start to realise that central banks have run out of ammunition, then I think there's going to be more of a move to gold than what we've seen so far. And when I look around the gold world, it's hard to go past Australian gold producers for the best return for risk. I just can't see a better return for risk out there in the gold space. All right, so that's my playbook for 2019. It's crystal clear to me, and I'll just touch on that when I finish up. American stocks, the index was 67 points higher, 2.5% for the week, so it was a great week in America. We've clearly broken back above the 200-day moving average now after being under it for some time, and it's looking good, but it's overbought, along with very powerful upward momentum. So You don't want to try and go short this market, but I wouldn't be buying it at this level either. The US dollar was down slightly during last week. The 10-year yield was steady at 2.66. So let's take a look at some charts. We'll start with this just amazing rebound. Going back 4 weeks when we were down here, I just couldn't conceive that this would have happened, and I don't think anyone else would have either. We would have expected some sort of retest of the lows. To get a V-shaped recovery is quite extraordinary. And it really leads you to conclude that part of this drop here was manufactured by computer algorithms and other vested interests. But nevertheless, we're back above the 200-day, which is positive, and that will help sustain the momentum because that's how technical traders operate. So I would expect that we're not going to see any short-term weakness, but we are overbought, so the market is dangerous at this point. I wouldn't be buying it at this point. And I'd be just keeping your powder dry, maybe even take some profit and wait for the dip. And at some point, that volatility will kick in. There'll be some sort of announcement or news item that will trigger another burst of selling, and that'll be an opportunity to get in. If we look at the US dollar, was about flat for the week, didn't really do a great deal. And just while I'm here, we'll look at the Australian dollar. So we're still in this trading range between 70 and 73.5. All right, let's turn to the Australian index now. Down a few points, down about 5 points on the week. So we've had a pretty good rebound. That was part of that was due once we got out of the Hayne report and all the conjecture about that. We got a rally in the bank stocks, and but that appears to be sort of petering out at the moment, and it's pretty hard to see how the Australian index is going to get back up above 6,300. There's just too many negatives. So slightly higher dollar, 71.4, but the fundamental outlook for the Australian economy really is quite poor. So I'm really quite negative on the broad Australian market, not on specific stocks that meet the criteria that I outlined before, but certainly on the broad market. Now, the rise in the Australian dollar on Friday was about a bit of US dollar weakness and some expectations that China would stimulate. But when you look at the Australian economy and the fact that the RBA has now put a rate cut on the agenda, you'd have to think the Australian dollar is going to go down below 70 at some stage, which means that assets in America are going to do very well in Australian dollars. Our index down by 5, and both banks and miners ran out of steam. Moving on to precious metals, gold was higher to 1322, and for months now we've seen the gold price just moving with the currency. US dollar went up, gold went down, etc. But not so on Friday. The US dollar was down very slightly, but the gold price moved up quite nicely. And GDX is showing some nice strength now, and dips are being bought. You look at the intraday patterns, and it's really clear gold stocks are being nicely supported at the moment. So there's the gold price. Clearly, higher highs and higher lows, virtually no retracements of any dimension at all. You can see we're not getting sell-offs like we had here back in November. It's just one day, couple of days, and then we're off again. So we're still in the same position. We really need to try and make a move above 1380. And I think if and when that happens, and I believe it's a when, then we're going to see. I think we're going to see quite a strong run in gold. GDX. Also, you can see the strength there. No dips in GDX. We're now definitely getting some more positive momentum in the gold stocks. Other commodities, copper steady at 280, which I've been scratching my head for quite some time now that copper should be higher price. And you look at the inventory levels, and that would suggest that copper should be higher with a good global outlook. It's pretty clear now that why the price has been weak for so long, and that's because the the people could see that the global economy was slowing faster than anyone thought. And so it would appear now that copper has probably been priced right all along. Crude oil sharply higher to 55.6. That was really about OPEC tightening supply. And it's still very political, oil. So I'll sort of, stay out of trying to predict where the oil price is going. There's the copper price. Inventory levels about the same. And there's the crude oil price. So we're back up in the 55s again. So just to wrap it up now, I'm cautious for all the reasons that I outlined at the start, but I'm excited by the slim part of the market that I think offers tremendous opportunity. So I'm very excited by that. And if you apply a good process to the right stocks, then you're going to do very well. But just picking the right stocks is not enough. It just isn't going to cut it. If you've got a sloppy process or no process at all, and you just sort of go in and buy at any time, then buying the right stocks is not going to be good enough. There's been there's some terrific stocks, but they've just run up 20% or 25%. If you go and buy them now, it's completely the wrong time to buy them. So you've got to have a process. And I've mentioned this before, and I'll keep mentioning it because I think it's the best risk-adjusted opportunity in asset markets right now, and that's the process of buying covered calls over the best stocks in the world, that when they're oversold and undervalued. I just can't see a better process at the moment. It has worked absolutely brilliantly since late December, and I would really encourage people that maybe don't know too much about the options market and have a negative view of it, just to open your mind a little bit and consider the possibilities. And if you don't know much about it, then I can help you, point you in the right direction. Portfolio Analyst this week is really about pursuing the above process. So it's process plus the right stocks, and I just think that is so critical going forward for all the reasons that I've outlined. So there's my contact details for non-members. Please feel free to get in touch with me, and we'll see what the next week brings. But to me, I'm just crystal clear in my mind about the way forward from here. So that's it for this week. Cheers.